Hello, today we're going to be making a video here about Google, Alphabet, and we're going to be looking at their free cash flow. Currently, they have free cash flow of 60 billion per year. This is in millions. As you can see here, it's grown a lot, and even in the past decade, we're really high up there. And their most recent quarter was 38 billion, so they're continuing to grow. I mean, they're basically already at 58 million for the year, so already going to surpass last year's numbers. Um, if you go ahead and look at 331, it improved year over year. If you look at 630, it improved year over year. So they're doing really good. Um, we just want to try to have realistic expectations, though, because if we come over here to their revenue, they had a big increase from 2020 to 2021, and then 2022 it slowed down a bit, and currently year over year where you only have a 4% increase, but the last quarter was a 7% increase, which makes sense. They're probably going to continue to grow a little bit higher than 4% going forward. Um, what we're going to go ahead and look at too is their net income. If you look at their net income, they're currently over the last 12 to 20 months at 60 billion, which is a 15% decline year over year. But their net quarter income was a 15% increase year over year, comparing the last couple quarters. So if you come down here, as you can see, 2021 was really unrealistic. We do know a lot of companies had a lot of net income and profitability during the COVID years. So, 59 billion, it kind of came down a little bit, and we don't expect it to continue to, be this high yet. But if you do look at 630 compared to 630, you can see, it increased a little bit. So, maybe they are going to be trending in the future towards this number, but I don't expect it to be 2023. Shares outstanding, if you come out here, they do decline year over year, so that's always a good thing. As you can see here, um, almost every quarter it's going down, and that's always a good thing for investors, something that you can always calculate in there, but we're not going to take our time to do that today. We're just going to take their numbers and do a quick little calculation based upon a few different revenue levels, because you want to kind of be prepared for what Google's going to do going forward. If you come to their assets and liabilities, I mean, they have a ton of assets that are increasing. You come to their liabilities, there's way less than their total assets, which is good. Their cash on hand, I mean, they have a ton of cash on hand. I mean, look at that, 118 billion. Look at their debt, only 13 billion, and it's declining 6.9% year over year. So they're in really good hands. They have really good um, cash. They have almost no long-term debt compared to cash, so that's always a good thing. If you come over here to their price, they're currently trading at 137.58. Their all-time high was 149.84, which is in 2021, and then their 52-week low was 83.34, which is 34.9% below the current share price. So, this was a company that if you're really going to get into it, you really did want to get into it when it was low last year, and a lot of us in my community, it's not my community, but in the community I'm in, that we invested in Google. We're doing pretty good. I don't currently own any more Google. I sold it all. I was too hard to pass up at the time, and invested into other opportunities. But I would like to get back into Google with a good price. They are a good long-term hold. But at the time, it just didn't fit my priorities for investing in Google. So I'm also currently on the train of wanting to get into Google. So let's just go ahead and take a quick little peek over here. Let's see. We didn't use 2013 to 2018 just because you wanted to keep it more around what they're currently growing at. We do have the 30 billion, the 42 billion, the 67 billion, and the 60 billion. We're not including anything for 2023 because it's not over yet. Right here, they are projected by a lot of analysts to grow forward at 9%. So we're going to use this as a growth rate too. We're only going to use an 8.5% discount for something like Google. Google is a great company. And we have $98.22. That is what it comes out to with a 9% growth rate. There's two other growth rates that I wanted to look at. 11%. because this is another common one that I've been seeing out there, and it's not too much off the 7% of the year-over-year where it's at right now. But they did have a slow year this year, so that 7% year-over-year is expected to actually grow into the future, if that makes any sense. So that would bring us to $114.33. And then if we go to 17%, which is not unrealistic for Google, if they are going to grow at 17%, now you can see where they come in undervalued, even at the moment, which is $179.82. Give myself a 20% discount rate, and they're still undervalued, $143.85 currently. So we do want to come over here to our discounted cash flow calculator that is aggressive, and we're going to go ahead and put in 50,209. 209. Oops. So we're going to do 50,209. We're going to use this 17% growth rate. And then we're going to do our outstanding shares. Is it 16,643? Yep. 13,643. Okay. 10% discount rate because this one's more aggressive, which is good. And you can already see that we're coming in at a discounted cash flow price of $221.87, $221.14. Just because of this cash on hand, this debt hasn't been changed yet. So let's just do that with this, and this is going to give us a crazy number. Watch this: 118,118,332. Just make sure that's right. 332. Okay. Long-term debt 13705. 13705. Perfect. Okay, so we're going to come over here to that 9% growth rate. Boom. $107.40, $115.07. And then we'll come over here to 11% growth rate, and we have $129.55, and then $137.22 when it's calculating in the cash and stuff. And let's go back to that 17. Boom, $229.54 when we're putting this in, and here's your discount rates, of course. This is with our aggressive calculator. There are a lot of people that do like to be aggressive with their calculations, and even if they grow at like a 13%, you can see their rates here. So it's all about finding that growth rate and what they're currently growing at. You can base it upon numbers now. You can base it upon what they're currently growing at. I don't know how realistic it's going to be for Google to only stay at a 4% revenue growth rate. But if it is, then they are overvalued. So it really just depends on what your margin of safety is. I currently think that they're going to grow somewhere between that 11% to 17% growth rate for a few years, but long term, I'm really not sure because there are a lot of competitors in the market, such as Microsoft, Apple. There's always going to be new players in the market. There are a lot of cloud things out there they're going to steal from Google. Google does provide a lot of free sheets like this. I don't want to pay for spreadsheets when there's free things like Google and LibreOffice. But yeah, we'll see how they do going forward, and let me know what you think the fair value is for Google. If I had to do a fair value right now, I would come down to here, probably put us at that 11% growth rate, and I would say fair value would be somewhere between my 10% to 20% discount rate. I'm not just going to go $114.33. So I honestly, $100. I would be looking to sell puts if I really had the money and who wanted to buy Google. I'd be selling puts for $100, even if it's a few months out or when Google starts getting lower. That's how I really look at it. And thank you, and have a nice day.